Good afternoon, everybody. Welcome to this month's webinar. Today we are continuing on our topic, financial instruments. Last month we looked at financial instruments, a bit of an introduction, the categories of financial assets, financial liabilities, etc. So today we're continuing with financial instruments, and we're specifically moving on to hedge accounting. All right, so the roadmap for this session, we have a bit of an introduction. Then there's the difference between a financial liability and an equity instrument. And then the biggest part of today's webinar is looking at hedge accounting. And then I'll also have a brief look at the new AASB 9 financial instruments. Now, the new AASB 9 has been issued in little bits and pieces, and finally we have the whole document, but it's only applicable from 2018, or mandatory applicable. But still a very quick overview of what we can expect if we want to start to get ready. So if we start with a little bit of an introduction, the categories of financial assets. We said last time, remember, we've got four categories of financial assets and two categories of financial liabilities. And in last month's webinar, we looked at the various definitions, and we said if you cannot determine the correct category, you're going to really struggle to get the accounting correct, because the categories drive the accounting treatment. Then we talked a lot about measurement and distinguishing between initial measurement, which is day one or the date of the transaction. How do we measure the financial assets and liabilities? And then subsequent measurement, so that's in future all our reporting dates or balance sheet dates. How do we measure our financial assets and liabilities? Now, this is a little bit of a summary of the subsequent measurement. So if you look at your financial assets, financial liabilities, how do we account for them going forward at each reporting date? And importantly, what do we do with the changes in values? So assets that are at fair value through profit and loss, subsequent measurement at fair value, changes go through profit and loss. If we look at loans and receivables and held to maturity investments, those two categories of financial assets are both at amortized cost, which means we have to do amortization tables. And then the fourth financial asset is available for sale. It's at fair value, but changes would go through other comprehensive income or an AFS revaluation reserve. And then at the bottom of the slide, the two liabilities, it's either fair value through profit and loss or other liabilities, which are most of our liabilities, will be at amortized cost. So again, an amortization table. So that's really a very quick overview of all the things we discussed in last month's webinar on financial instruments. Today I want to move on to financial liability versus an equity instrument. And this topic, or this specific area, is covered in AASB 132, or internationally IAS 32. And really what it's saying is that we're looking at substance over form. So in the old days, if we had ordinary shares or preference shares, legally they are shares, legally they equity. We accounted for all ordinary shares, preference shares, based on the legal form, and we said it's equity. The new AASB 132, or I say new after 2005, they say no, we have to look at substance over form. So ordinary shares would meet the definition of equity because it's a residual interest. If you take all the assets less the liabilities, whatever is left would belong to the ordinary shareholders, therefore it's a residual interest in the net assets of the entity. So ordinary shares, substance over form, that would be equity. But they've asked the very important questions. So what is, and I'm putting in brackets there, in substance, what is in substance the difference between a 10% redeemable preference share, and a 10% debenture. So if you look at the first one, a 10% redeemable preference share, so we've got the 10% interest or dividend that's being paid every year. It's redeemable, so it will, let's say it will be redeemed in 5 years' time. And if you compare that to the 10% debenture, 10% interest every year, and it will be repaid, I don't know how I've spelled that, debentures. There's an extra T in there. I just noticed it. But if you look at a 10% debenture, there's a 10% interest. And also, let's say in 5 years' time, the capital amount will be repaid. So if you look at those two, a 10% redeemable preference share and a 10% debenture, both carry interest or dividend at 10%. Both instances, the capital will be repaid in 5 years' time, and therefore in substance, they're the same thing. And in substance, both of them would meet the definition of a financial liability because the entity have an obligation to pay cash in 5 years' time. So very important that we not only look at the legal form to determine the legal form of a contract, to determine whether we've got equity or financial liability, but that we look at the substance. Which brings us to the last area, which is a compound instrument. And now we have a situation where if an entity, for instance, issues 10% convertible notes, and those notes are convertible into shares of the company in 5 years' time, and at the option of the note holder, we've got a little bit of both in there. Because on the one hand, we have to pay the 10% every year, and potentially we have to pay the amount back to the note holder. But there's also an option in there, and an option is an equity. We could the note holder could say, don't repay the capital, but instead give me shares in the company. They've got that option. So a compound instrument, a little bit of both. And then AASB 132 gives us rules on how do we split our compound instrument into a financial liability and an equity instrument, and what is the treatment after that. So a compound instrument, the financial liability would be the net present value of what we expect to pay in future, and the balancing figure would be our equity instrument. Our equity instrument would never be restated going forward. However, the financial liability will be remeasured at every reporting date. I think my final comment on this, I just wanted to flag this as a potential area of interest, and that you have to be very careful about this, is that if you've classified, for instance, a 10% redeemable preference share, you've looked at it and you said substance, it's a financial liability. Whenever you pay that 10% dividend, legally it's a dividend, we would account for it as an interest expense. So really important that the interest, or the 10% that we pay, would follow the original accounting journal. If we've classified it as a liability, we'll have interest expense in future. If we've classified it as equity, we'll have dividend in future. And what about a compound instrument? If we've split a compound instrument between financial liability and equity on day one, then in future the payments we make will be split between interest expense and dividend. So financial liability versus equity instrument is a really important area. It's a highly complex area. Whenever we get a convertible note, we have to analyze what's the substance. Does the entity or the note holder have the option to convert? Are the 10% that's paid, is it mandatory? To what does it convert? So a lot of considerations, and that's an area where we'll have to clearly document our thought processes. So this next area I would like to look at is hedge accounting, and that's the main focus of what we're looking at today. Now, hedge accounting, I think the biggest issue around hedge accounting is that often when you speak to people, they say we enter into hedging to, for instance, or as example, protect our future cash flows. And therefore, we want to use hedge accounting. And people assume that the fact that you've entered into hedging arrangement automatically allows you to apply hedge accounting in terms of AASB 139 or IAS 39. And that's not the case. So I want to start with what is hedging, or one should say what is economic hedging in the general sense. If a client would tell you we are hedging, they mean that economic hedging is a management technique, and the idea of it is it's designed to eliminate or reduce a financial risk that an entity is exposed to. Now, usually entities would use hedging if they know that they have a future cash outflow. For instance, they have to pay for inventory that they import from the US and they have to pay in US dollars. They don't like the idea that the exchange rate between Aussie dollar and US dollar could move against them, and therefore they enter into a foreign exchange contract. So once they enter into that foreign exchange contract, they fix the exchange rate. Now they know exactly what amount of Aussie dollars they would have to spend in 3 months' time to pay the US dollar creditor. So it takes away that uncertainty, it takes away unnecessary risk. So that's why we enter into hedges. So I've got two examples here. The one is we've got a variable interest loan and we expect the market interest rate to increase. And you think, you know, I don't want to pay a variable interest rate if interest rates are going up. So I should enter to offset that risk or limit that risk, I should enter or I should swap over to a fixed rate loan. And we often see this with home loans in your personal finances. If you've got a variable interest rate loan, you expect the interest rate to go up, you can go to the bank and fix your home loan. It costs you a little bit more, but you've got a bit of certainty. Or if you've got a fixed rate home loan, you would say, interest rates are going down, I've been a bit silly to fix my home loan, let's see if we can swap it and have an interest rate swap where I swap my fixed interest rate with somebody else who have a variable interest rate. And my second example is we import inventory from overseas, we need to settle the creditor in US dollar, and we expect the exchange rate between Aussie dollar and US dollar to weaken. So people would say, I've entered into these hedge contracts, and into these derivatives, foreign exchange contract, interest rate swap, to manage my risk or to fix the amount of cash flow in future. And then there's that expectation that they can now use hedge accounting. Now, economic hedging and the fact that you're managing your cash flows is fantastic. Fantastic to do that. If that's how you want to manage your business, no problem. But be careful. Hedge accounting is a technique that changes the basis for recognizing gains and losses on hedged items. So a hedge item could be that for overseas creditor that you have to pay, or hedging instruments, so the derivative, the foreign exchange contract, so that they are both recognized in the same accounting period. And it reduces volatility on your profit and loss. So hedge accounting is when you comply with the requirements of AASB 139, you get certain relief on how you recognize changes, gains and losses on hedged items and hedging instruments, and you get to matching. And we're trying to get to a nice smooth profit and loss. So it says that an entity may, if they meet the conditions outlined in AASB 139, apply hedge accounting rules and principles to reflect the substance of this economic hedge that is already taking place. So the fact that you've got an economic hedge does not automatically entitle you to the benefits provided by hedge accounting. If you want to use hedge accounting, you have to meet certain conditions. So the biggest issue is that economic hedging doesn't automatically equal hedge accounting. And often clients or people who've used economic hedging get really upset about this, because they would say, we've entered into the hedge, we've fixed our cash flow, but you accountants now want us to have volatility in profit and loss because you still want us to account for the import of the inventory at spot rate and to account for the derivative separately on its own. So it's very important to have this discussion that economic hedging, although it serves management purposes, does not automatically equal hedge accounting for preparation of financial statements. So if you look at the types of hedging arrangements available, you have a fair value hedge, a cash flow hedge, or a hedge of a net investment in a foreign operation, which is fairly rare and specialized. Therefore, today I would like to look at a fair value hedge and a cash flow hedge only. A fair value hedge would be if you are concerned about changes in the fair value of a financial asset or financial liability, and you want to protect against that. An example would be if you've got a fixed rate loan and you know interest rates are going down, and suddenly the fair value of your loan is going down and it's subject to fluctuation, because if you've got a fixed rate and you are paying at a fixed rate of 15%, but the variable rate is going down to 4, 3, 2%, you know, there could be a huge fluctuation or change in the fair value of that instrument, and that could reflect really badly in your financial statements. So you enter into a derivative where you expect the fair value movement to be in the opposite direction, so that the two together get to a more or less zero impact on your profit and loss. So that's one alternative, and I'll show you an example. Another alternative, and I think the one that's used more often, is a cash flow hedge. So that could be where you import inventory and you have to settle the creditor in US dollar or foreign currency, or where you sell inventory to overseas customers and they pay you in another currency, and you then have to convert that currency into Aussie dollar. It could be that you've got a loan that you have to repay in US dollar, or you've provided a loan to a subsidiary overseas and they will repay you in US dollar. So there's some kind of transaction going on, some cash flow going on, and the cash flow is not in your currency. So if you're in Australia and your currency is Aussie dollar, it's a transaction that's not you know, it's not in your Aussie dollar currency. So if you look at hedge accounting concepts, I just want to cover two, and that the one is you've got a hedged item, and I'm trying to put it quite simplistically and saying a hedged item is the item that the entity is trying to protect. And a hedging instrument is the item the entity uses to protect that hedged item. So on the one hand, you've got the hedged item. I'm worried about this item's fair value, or I'm worried about this item's cash flow implications. On the other hand, you've got a hedging instrument, which usually is a derivative, for instance, a foreign exchange contract, an option, an interest rate swap, and this is the instrument that you are using to protect your hedged item, because you are designing your hedged, if you expect your hedged item to go up, you design it so your hedging instrument will go down. Or if your hedged item go down, you design it so your hedging instrument will go up, and the net effect is as close as possible to zero. So I've talked about this earlier, and this is really crucially important and a discussion to have between clients and us as you know, advisors or as auditors, and that is there are certain conditions that you have to meet to apply hedge accounting and to get the benefits of hedge accounting. So the first thing is that the hedging relationship must be formally designated, and documented at the inception of the hedge. So we have to say this is the relationship, this is the hedged item, this is the derivative. We document all of that, and the documentation should include a number of things, but key things is what would be the risk management objective and strategy. Identify the hedging instrument, the hedged item, what is the risk, and then also how effectiveness of the hedge will be assessed. So the hedge effectiveness has to be assessed on inception, but also continuously going forward, retrospectively, to ensure that this hedge that we've designed is actually effective. So that's the first thing. The hedging relationship must be formally designated and documented. And to our clients, if you want to go down this path, you should contact us so we can work with you to get the hedge documentation in place that meet all the requirements. And then the next one is there must be an expectation at inception and on an ongoing basis that the hedge will be highly effective. So this hedge effectiveness testing results must also prove that this hedge has actually been effective throughout the reporting period. So we have to do hedge effectiveness testing at each reporting date in order to continue to be able to use hedge accounting. So if you go back to the previous slide, you have to state right up front in your documentation how are you going to test hedge effectiveness. And then every reporting date you have to perform that test in order to continue with the privileges around hedge accounting. And then also for cash flow hedges of a forecast transaction. So a forecast transaction, for instance, we've ordered inventory, we haven't received it yet. You can still enter into a hedge because you order the inventory, you expect to receive it, and then you expect to pay at a later date. That transaction must be highly probable, and it must expose the entity to variations in its cash flows that would ultimately impact on profit and loss, because once you've got the inventory, once you sell it, it goes to cost of goods sold and it impacts profit and loss. So quite a number of conditions, so please be very careful. I think we should be very careful when we talk about hedging, to differentiate between economic hedging for practical cash flow management purposes and hedge accounting, which is a privilege in terms of AASB 139. It's got great benefits, but you have to meet the conditions to apply it. So if we look at hedge effectiveness testing, hedge effectiveness is calculated as the cumulative change in the fair value of the hedging instrument divided by the cumulative change in the fair value of the hedged item. Now, interestingly enough, I can never remember this formula, and interestingly enough, in this equation, it does not matter which of these items is the denominator and which is the numerator, because they say hedge effectiveness is it's effective if it's between 80% and 125%. And I always wondered, where did they get the percentages? So if you look at the bottom of the slide, let's say we start with 125%. So if we put 125 divided by 100 will give me the 125%. Or if we forget our formula and we put it the other way around, it will be 100 over 125, which equals 80%. So it doesn't matter which way around you do this formula. It is a comparison of the cumulative change in the fair value of the hedging instrument over the cumulative change in the fair value of the hedged item. So really what we're saying, cumulatively, we wanted to protect the hedged item. So were we successful? So the cumulative change in the hedged item over the cumulative change in the hedging instrument, the instrument we used, did we get it right? And I suppose the next thing is, what are the implications if we do that test and it's ineffective? So if it's effective between the 80% and 125%, fantastic, there we go. If it's ineffective, it means the ineffective portion would end up in profit or loss, and we'll get volatility and we won't get benefits of hedge accounting. So what does that mean for a fair value hedge? And I'll show you the example shortly. Is for a fair value hedge, if you've got an ineffective portion, you do not need to process an additional journal in respect of the ineffective portion. This ineffective portion will automatically end up in profit and loss. So you just do what you always do for your fair value hedge, and the ineffective portion will end up in profit or loss. However, if you've got a cash flow hedge, you have to do a specific journal to deal with the ineffective portion. And how it works is that the ineffective portion would go to profit and loss, and you have to process that journal to make it happen. And the effective portion would go to other comprehensive income, or it would be disclosed as other comprehensive income, and the reserve account would be the cash flow hedge reserve. So how do we do that? The amount that we recognize in other comprehensive income is the lower of, and we look in absolute terms, is the lower of the cumulative gain or loss on the hedging instrument, or the cumulative change in the fair value of the hedged item. So the lower of those two amounts enter up in other comprehensive income, and the rest is ineffective and it will go to profit or loss. So a fair value hedge, the ineffective portion would automatically end up in profit and loss. For a cash flow hedge, we have to do this calculation, and we have to process the specific journals. So let's look at a fair value hedge example. Now in my example, I've said that the entity that's listed on the Australian Securities Exchange, it's decided to purchase a convertible note issued by another entity. The face value of this convertible note that we've purchased with $10 million, and it pays interest at 7% annually. But then the entity also decided that we are a little bit worried about the potential movement on this interest rate risk, and therefore we entered into an interest rate swap. So that's our derivative. And then we are given this information. So on the 1st of January year 2, we entered or we purchased our convertible note, and we also entered into our interest rate swap. And this is the information over the first year. So important to note, on day one, when you enter into the derivative, it doesn't have a fair value because the transaction price would be the market price on that date. So on day one, the derivative don't have a fair value. And if you look at your hedged item, the item we want to protect, we've got the convertible note, our financial asset, that's $10 million. Then on 30 June, 6 months later, the fair value, our interest rate swap now has a fair value. At 30 June year 2, it's got a gain, so it's a financial asset, and the fair value of the hedged item has gone down. So we can see this has been a good thing because our derivative increased in value and our hedged item decreased in value, and then the same happens at 31 December. So you can assume for my example purposes that the convertible note, your hedge item, is correctly classified as a loan and receivable, and that the hedge relationship passes both the prospective and the retrospective effectiveness tests. So we can assume that this is nice and effective, so we are going ahead with hedge accounting. I think what's important to note here, if we didn't apply or comply with all the conditions for hedge accounting, we wouldn't have an accounting matching principle going on, because the convertible note is a loan and receivable. How do we account for a loan and receivable subsequent to initial recognition? A loan and receivable would be accounted for at amortized cost. Because we qualify for hedge accounting, because it's effective and it's a fair value hedge, we are worried about the fair value of this hedged item. In this situation, our derivative is at fair value, and now our loan and receivable is also accounted for at fair value and not at amortized cost. So if we've got a fair value hedge, we always have a derivative, and a derivative is always at fair value for profit and loss, and we don't touch that. That stays the same. But with a fair value hedge, what we do is the hedged item, if it wasn't a hedge or didn't meet the requirements, would have been at amortized cost. Because it's a fair value hedge, we account the hedged item at fair value. So that is the benefit that we get here. And we are hoping that the change in the fair value of the hedge item is more or less the same in the opposite direction of the change in the fair value of the derivative. So if we use these numbers, and you could maybe keep these numbers in front of you, this is what the journals would look like. On the 1st of January, there's no journal entry for the derivative, because the fair value at the transaction date is 0. But for our convertible note, our financial asset, we would say debit convertible note financial asset at the 10 million, and we credit cash the 10 million. So that's the initial recognition of this financial instrument at the transaction price. Then 6 months later, the convertible note, the fair value is only 9 million. With my numbers in front of me, I'm supposed to remember it all, and suddenly I get myself confused. So 6 months later, our convertible note has a fair value of only 9 million. So our convertible note asset, we have to credit with 1 million to get it to the fair value of 9 million. And we debit fair value loss on convertible note, which is a profit and loss account of 1 million. So you can see here we are accounting for this financial asset, although it's the category loans and receivable, we're not accounting for it at amortized cost, we're accounting for it at fair value. Because we've got a fair value hedge, we meet the conditions. If we go to the derivative, there was a change in its fair value from the 1st of January of 965,000. It is a gain, so we've got a financial asset derivative in our statement of financial position, and we credit fair value gain on derivative. So you can see the net effect of the loss in the first journal of 1 million and the gain on the derivative of 965 is not 0, but it's close to 0. It's definitely not that volatile. Imagine if we didn't qualify for fair value hedge accounting. Then we would have had a fair value gain on the derivative in our profit and loss, but the convertible note would have been at amortized cost at a very different amount. So we get some smoothing or matching by using fair value hedging. If we go on to 31 December, we debit the fair value loss on the convertible note. It goes down another 2.9 million. We credit the asset with a 2.9 million, and we can see that there's another gain on our derivative of the 4 million. So let's say by 31 December we figured out, when we do our calculation, all right, I've said you assume that it's effective, but if it was ineffective, we wouldn't need an additional journal, because the net effect of the fair value loss and the fair value gain would automatically go through profit and loss. So there's no need for a specific journal for the ineffective portion. So it's really important. A fair value hedge is the easier one, because the big change is that the financial asset or the financial liability, the hedged item, will no longer be accounted for according to the normal rules, for example, amortized cost, but it will now be at fair value. The other thing that I have not included in here is the tax implications, because often, I mean, as soon as you've got a fair value loss or a fair value gain, there's also an impact on taxation. And maybe it's not on current tax, usually it's on deferred tax. So that's just another thing to consider when you do this in practice. The one that's more problematic is a cash flow hedge. It's the one that we see more often in practice and the one that's quite difficult. So I've thought, let's look at inventory, because this is where we often see it. And let's say we take out a foreign exchange contract. And you can take out your foreign exchange contract before the delivery of the inventory or after the delivery of the inventory. And if it's before the delivery of the inventory, my first alternative and my first example is we don't apply hedge accounting. Maybe we don't have the documentation in place, or we're not fast to apply hedge accounting. So alternative one, I want to show you the numbers if we don't apply hedge accounting. And there will be a profit and loss impact, and I'll show that to you. Then in my second alternative, we take out the foreign exchange contract before the delivery of the inventory, but now we meet the requirements for hedge accounting. We decide we want to do hedge accounting. It's effective, and because it's effective, there will be an equity impact, and you can assume that it's effective, just for my example. And then the third alternative I'll show you is if you take out the foreign exchange contract after delivery of the inventory, which in that situation you're not allowed to use your hedge accounting because you didn't have your documentation and designated all your hedge documents before the delivery of the inventory, and I'll show you the profit and loss impact in that situation. So three alternatives. I want to contrast alternative 1 and 2, and it's around cash flow hedges. So let's look at the information first of all, and it might be useful for you to keep the information next to you or in front of you as we work through the journal. So in alternative 1, and this is just to create a contrast, we have no hedge accounting. So let's say on the 15th of October, year 8, the entity orders inventory to the value of $800 US. The exchange rate at that date is given, the 64 Aussie cents, and we enter, at that date, we enter into a 3-month foreign exchange contract, 70 cents. Then on 31 December, we've got the year end. We have not received the inventory yet. We now have the exchange rate at year end, and we also get from the bank the 15-day foreign exchange rate. I should say, remember the 3-month foreign exchange contract that we enter into on the 15th of October would mean settlement on the 15th of January. So when we get to 31 December 2008, and we want to determine what is the fair value of that foreign exchange contract, you do not compare the foreign exchange contract rate at 31 December with another foreign exchange contract of another 3 months. You compare it to a foreign exchange contract that would settle at the same date, and that is 15th of January, and therefore it's the 15-day foreign exchange rate. So that's a common mistake in practice, that we think we've got a 3-month foreign exchange contract, and therefore we ask the bank for the 3-month foreign exchange contract rate at 31 December. You should look at settlement and look at the rate of a contract at year end to settle at the same date. So that's why I give you the 15-day rate. And then on the 15th of January, the entity receives the inventory, settles the creditor, executes the foreign exchange contract that they've got in place, and the spot rate on the 15th of January is a 62 US cents. So that's a little bit of information. So let's do the journals on the 15th of October, the 31st of December, and the 15th of January. We do not have any hedge accounting. So on the 15th of October, we order the inventory, therefore there's no journal entry. When you order inventory, you've not taken on the risk and rewards, no journal entry, absolutely. And also, we don't have a journal entry in respect of the foreign exchange contract because the fair value at that date would be 0. Then on the 31st of December, We've not received the inventory yet, so we cannot say debit inventory, credit creditor. We haven't taken on the risk and rewards. However, we've got a foreign exchange contract. The rate, or it was a good thing that we've taken out this foreign exchange contract because we took out the contract at the 70 cents. The 15-day foreign exchange rate is 66 cents, so this was actually a good decision. So we say debit derivative asset 69, the fair value of this foreign exchange contract, and we credit profit and loss 69. So in the year ended 2008, we've got a 69 gain in profit and loss, and we still have no inventory. If we go on to the 15th of January the next year, we receive the inventory, and AASB 121 or IAS 21 says you account for inventory at the spot rate. Therefore, you would say debit inventory at the spot rate of the 15th of January, which is 62 cents, and you credit the creditor at the spot rate of the 62 cents, and that is the 1290. But also on the 15th of January, we know we've got this derivative. So the first thing we do is account for that derivative at fair value. If you work out, if you look at your derivative, we've got a derivative at 70 cents. The spot rate on the 15th of January is 62 cents. So we're saying this was a real good decision. And we work out what's the fair value of this derivative, this foreign exchange contract. But then we remember that at 31 December, we've already included a derivative asset of 69. So that's why you can see I work out the fair value of my derivative asset on the 15th of January, but I deduct the 69, which I've already included in my financial statements on 31 December, and I say I debit my derivative asset with an additional 78. And again, I credit profit and loss with 78. So at this stage, on the 15th of January, I now have in my books a derivative asset at just look at my notes, I can't do the maths, at 147. So first on the 15th of January, I bring in my inventory at the spot rate. Then I make sure that I've got my derivative asset at fair value, remembering that I've already fair valued at 31 December. And then I, at this stage, say I pay my creditor. Now I would say credit my cash. Now the actual cash outflow would be the cash at the spot rate that I pay the creditor, less I execute my foreign exchange contract, that the cash flow is there for only 1143. So I credit cash the 1143. I debit my creditor. I no longer have the creditor, the 1290. And I credit derivative asset in respect of this foreign exchange contract, the 147. So if you look at the profit and loss impact, in 2008, we had a profit of 69 on the derivative, and 2009, we had a profit of 78 on this foreign exchange contract. And the other thing to remember is our inventory in our books. In this example, our inventory is at the spot rate of 1290. So although my cash flow was 1143, my inventory is reflected at 1290. Now, quite often clients tell us, I don't want my inventory at 1290. I've entered into a foreign exchange contract to fix what I'm going to pay for the inventory. I wanted to fix that I'm only going to pay the 1143, the rate in the foreign exchange contract. And the client achieved that. The cash outflow was only 1143. However, the accounting standards, if you don't apply for hedge accounting, would still force you to account for the inventory at the spot rate and therefore the 1290. So that's where the difference between economic hedging and hedge accounting comes in, because clients often expect to account for this inventory at the amount they've actually paid, because they say that was the purpose of the economic hedge. The purpose of the economic hedge was to protect their cash flow, and hedge accounting in terms of accounting standards can lead to something different. So let's look at alternative 2. Exactly the same information. I've repeated the information. It's exactly the same. And let's just see what the impact would be if we have the same transaction, but now we qualify for hedge accounting and we've got hedge effectiveness in place all around. So on the 15th of October, when the entity order the inventory and enter into the foreign exchange contract, still no journal, we don't have the inventory, and the fair value of the derivative is 0. Then on the 31st of December, we've not received the inventory yet, we can't account for it, but we've got a foreign exchange contract. We determine the fair value, which is 69, similar to alternative 1. In this situation, we qualify for hedge accounting, so we say debit derivative asset the 69, which is the same as our previous alternative, but now we don't credit profit and loss. We credit a cash flow hedge reserve or other comprehensive income with 69. So there's no impact on profit and loss at this stage. We are actually keeping it in a reserve in hedge accounting until the transaction happens, until we actually receive the inventory. So the next journal on the 15th of January, we receive the inventory, therefore we say debit inventory at the spot rate, which is 1290, and we credit the creditor at the spot rate. So that's exactly what we did in our previous example. The next journal is different. We remember that we've got a foreign exchange contract, and therefore we say debit derivative asset with the 78. Remember, we work out the value of the derivative asset is the 147, and we say, but we've already accounted for the value on 31 December of 69. So we say debit the derivative asset with an additional 78, and we credit a cash flow hedge equity reserve of 78. So at this stage, we have our inventory at spot rate, our creditor at spot rate, we have our derivative asset at fair value. All of that is the same, but we still have the movement in the foreign exchange contract hidden away in a cash flow hedge equity reserve. On the next slide, I think on your version, the top slide or the top journal is a repeat of the previous journal. Could you please put a line through that? I only saw that after I've sent out the slides. It should only have the following 2 journals. On the 15th of January, we now settle the creditor. So we say debit the creditor, the 1290. We credit our derivative asset because we no longer have the foreign exchange contract, the 147. And we credit cash because the cash flow is only whatever we agreed in our foreign exchange contract, the 1143. Everybody's happy, they've protected their cash flows. So that's again still the same. The next journal is we say, remember, we've built up a cash flow equity reserve. At 31 December we had 69. At 15 January we had another 78. So we are sitting with an amount in that reserve of 147. We've now received the inventory. So we can release the reserve. So we debit the reserve with a total 147, and we credit inventory with the 147. Now the effect of this is that the inventory is now accounted for at the actual cash that we paid for the inventory. Because on the previous slide we brought the inventory in at the spot rate of 1290. So we said inventory at spot rate 1290 when we received the inventory. However, we realized that we've built up a cash flow equity reserve of 147, and now that we've received the inventory, we release that reserve to inventory. And inventory is at the amount that we've actually paid, 1147, and we've got happy clients, all right, because they are saying there's no profit and loss impact in any year because the change in the fair value of the derivative went to a reserve. It never went through profit and loss. And the inventory is now in their books at the foreign exchange rate. And that is the actual cash that they paid for the inventory. So they said we wanted to fix the cash flow that we pay for the inventory. We've actually managed that. So we fixed our cash flow, plus we got the benefit of accounting for the inventory at that exact amount. So if you look at alternative 1 versus alternative 2, the benefits of hedge accounting are quite clear, that there's no volatility on profit and loss, and your inventory are at the rate that you've paid the cash. And that's why it's worthwhile getting the hedge documentation and the hedge effectiveness testing in place. My third alternative is where you enter into the foreign exchange contract after you receive the inventory, which is too late. If I say too late, it's too late to apply hedge accounting and get the benefits of hedge accounting. However, it's still in time in order to protect your cash flow in respect of the creditor. So the entity orders the inventory, they have an exchange rate, they take delivery of the inventory on the 15th of November, and then on the 16th of November they enter into a foreign exchange contract because they'll only be paying for the inventory on the 15th of January. So on the 15th of October there's no journal. On the 15th of November they bring in the inventory at the spot rate, the creditor at the spot rate. On the 16th of November, there's no journal entry because the fair value of the foreign exchange contract is 0. On the 31st of December, we have to restate the creditor to the spot rate at year end, and we have to account for the fair value of our derivative asset, which is 70 in this case. And then on the 15th of January, we restate the creditor, we restate the derivative asset, and we pay the creditor. So the cash outflow is still fixed at the 1142, but we have some volatility over profit and loss over the period. So that was just 3 alternatives looking at cash flow hedging and the benefits of entering into a cash flow hedge, not just for economic reasons, but if you qualify for hedge accounting in terms of AASB 139. So the last part, the last part is AASB 9, financial instruments. At the moment, our current financial instrument standards are AASB 1 through 9, that looks at recognition and measurement. We've got AASB 1 through 2 on presentation. We've got AASB 7 on disclosure. So we've got a complex set of accounting standards, and there's been a lot of pressure on these accounting standards during the global financial crisis. Specifically, there was a lot of pressure on the International Accounting Standards Board on their one financial asset called available for sale financial asset. And the reason is if you've got an impairment of an available for sale financial asset and you end up with an impairment loss in your profit and loss, in the next year when there's a reversal of that impairment loss, it doesn't go to profit and loss, but it actually goes to an AFS revaluation reserve, which in practical terms mean that bad news about AFS financial assets end up in profit and loss, and good news always end up in a reserve, never in profit and loss. So there was a lot of pressure around AFS financial assets, and the other reason is that the US rules were not as strict on AFS. So a lot of pressure on the International Accounting Standards Board, and they issued AASB 9 in pieces because they were quite desperate to react to the criticism. It's the first time we've ever seen an accounting standard issued in pieces and not as a whole finalized document. Fairly recently, they've issued the last part of AASB 9. It's taken them about 5 years to issue all the parts. So AASB 9, if we look at that financial asset side, there will now only be 3 financial assets, and they will be financial assets at amortized cost. So that's our current loans and receivables held to maturity. There will be financial assets at fair value through profit and loss, and that's the alternative which the International Accounting Standards Board prefer, that all financial assets are at fair value through profit and loss, and therefore they make it quite hard for us to get into the first one, financial assets at amortized cost, and you've got criteria to meet in order to be at financial assets at amortized cost. And then the third alternative is that you can have equity investments, so investments in shares, could be designated at fair value through other comprehensive income. It can be done on a case-by-case basis. It's an irrevocable election, so if you decide that this investment will be at fair value and changes go through other comprehensive income or a reserve, then positives, negatives, gains and losses, everything forever will go through other comprehensive income. You cannot change your mind. So in a good year, you put it in profit and loss, and in a bad year, you expense it. So this is a little bit of a decision tree to help you to decide. So if you look at the top, on the one hand, I've got debt. So how do we account for debt instruments? So with a debt instrument, you have to ask whether it meets the business model test. And if it meets the business model test, you have to consider what are the characteristics of this financial asset, and there's a specific test for that. And if it meets that, you say yes. Then you will say, do you want to use the fair value option? And if you say no, you can keep it at amortized cost. So you can see if you want to keep debt at amortized cost, you have to pass the business model test, and you have to pass the characteristics of financial asset test. So for debt to end up as amortized cost, you've got two hurdles. If you don't pass the test, or if you've got a choice and you pass the test but you still want to, your debt can be at fair value through profit and loss, because they actually prefer financial instruments at fair value through profit and loss. Derivatives, similar to what we currently have, are at fair value through profit and loss. And then if you look at equity, so equity instruments, the first question is it held for trading? And if you say yes, it should be at fair value through profit and loss. If you say no, you get the option, do you want to put the changes in fair value through other comprehensive income? It's an irrevocable election. If you say yes, you can have it at fair value through other comprehensive income. If you say no, it's fair value through profit and loss. So really what we've got is equity you have to account for at fair value through profit and loss unless you choose to always put it in other comprehensive income. So it's quite a simplistic diagram, but there's a lot of tricks and traps. And then also there's new hedging rules, new impairment rules, new reclassification rules, but it's a number of years off. So just to give you some idea what's happening in the space financial instruments. So the roadmap for the session in this one, we looked at a bit of an introduction or a recap of last time. We looked at financial liabilities versus equity. We looked at hedge accounting, and then we looked at the new AASB 9 going forward. So for the first time in a number of months, I've actually stuck to my time. So if you've got questions, please send them through. Otherwise, have a great weekend. I'm going to the cricket on Sunday evening. I think my husband's going to be really sad the whole evening. My kids are going to be super excited. So go the Aussies.